Bueno, escuché el segmento anterior, Scott, y creo que estoy más en el bando de Jamie Dimon. Ya sabes, en el punto de Steve Lehman de que hay opacidad en el crédito privado. Y ese es el problema con el que los inversores van a lidiar durante algún tiempo, y creo que, junto con las tensiones comerciales y, ya sabes, el pico del VIX, es la razón por la que los inversores son un poco cautelosos. Pero no creo que eso vaya a cambiar, los mercados todavía tienen muchos vientos de cola hasta fin de año.
Well, Scott, I heard the last segment, and I do believe that I lean more toward Jamie Dimon's position, which is that private credit has opacity, and for some time to come, investors will have to deal with that issue. And I believe that's the reason why investors are a little wary, along with the trade concerns and the VIX surge. However, I don't think that will alter the fact that markets continue to have strong tailwinds until the end of the year. Additionally, AI is a contributing factor. I believe that demand is increasing in this area, and we know that investors have a lot of cash on hand, and institutional investors are having a very bad year. Merely 22% are surpassing the standard. The sentiment has become negative, which is always a contrarian buy signal. Therefore, I believe there is a little chase going on. In my opinion, this building wall of concerns, including the shutdown, prepares us for a strong rally towards the end of the year. However, it seems that you are aware of this enough to believe that it has at least altered the market's short-term dynamics, if not the private credit landscape as a whole. I mean, the stock market will not do well if private credit and the leveraged loan market continue to have problems. You wouldn't think, really. Yes, Scott, the only thing I'm unsure of is how many chapters it will take to finish because, there's that opacity that people find frightening. But there's also actual credit deterioration, which I don't believe is occurring. And I believe this is the reason Adam and everyone else labeled it peculiar. Because of the way high-yield spreads have performed, I'm somewhat in that side, since private credit has, in my opinion, been one of the largest allocations for alternatives. I believe it has more to do with the flow of money. Investors will be prompted to reconsider perhaps. This market is not as straightforward as it appears. I believe you told me a few weeks ago that it was reasonable to expect the S&P to reach 7,000 by the end of the year. Do you still believe we may receive an additional 5%? That's how it appears. Between now and then, it is 5%. Scott, do we possess that? After all, 5% is merely the average for the fourth quarter between 1950 and 2024. However, the Fed is easing following a protracted hiatus. In 2024, that would be 1998. Therefore, I believe that the basic case may be 5%. I'm willing to wager that it will ultimately be closer to 7%, 8%, or even 10%. 7,000, in my opinion, is the lowest we can finish the year at. Whoa. And what role do incomes play in that? Earnings will be important, but so far, it's been a positive beginning. We haven't even entered earnings season yet. The banks have performed well. 82% of businesses are outperforming. We're sort of working our way through it, so demand is much more visible and tariffs are less of an issue. As a result, businesses are more visible for the upcoming year. I believe that the outlook will be positive, which will benefit stocks. Additionally, I believe that multiples still have a lot of room to grow. Therefore, this market isn't too demanding, in my opinion. Your suggestion that you would purchase small-cap stocks and regional banks intrigues me. Why would you agree to that? It's like putting on a swimming suit and diving in, but that's not dipping your toe in the water. Why? People from 2023 have a lot of muscle memory, Scott, and that's because of a significant rate adjustment that really threw many banks off guard in their business model alone. That does not imply that the same problem should arise in this crisis, which is essentially about whether underwriting is being done correctly. Therefore, I believe that the regional banks and small caps have been subjected to a throw the baby out with the bathwater situation. Therefore, I do believe that the Russells will be among the beneficiaries, even though they had a difficult week. Even when looking at results, small cap profits are expected to increase by 48% in the third quarter. Compared to the S&P, it is roughly 4 or 5 times larger. Therefore, I believe there is still a lot of room for improvement. How do you feel about the Great 8, the Mag 7, or the so-called AI bubble? What bubble, huh? Yes, that's just what I wanted to know. You see, we don't believe we live in a bubble. Indeed, there are many concerns around vendor financing and the circularity of some of these transactions, but I believe that this is just another indication that supply cannot keep up with demand. Therefore, the fact that businesses are investing in one another contributes to the expansion of that ecosystem. In the end, this represents roughly 13% of Nvidia's total revenue, which is not a significant amount. And to reiterate, the Big Four hyperscalers continue to finance a significant portion of the capital expenditures, correct? Even after capital expenditures, these businesses continue to have very strong cash flows. This year, they hope to generate over $200 billion in cash flows. It is crucial to keep in mind that it is not highly reliant on debt financing. Vendor financing isn't everything. Additionally, you've had a rather good earnings season thus far. Companies like TSMC have told you that demand is still high, far higher than they ever anticipated 3 months ago. Additionally, token computation is growing at exponential rates. Do you still believe that Nvidia is a good investment? Given the chips, the grid, and the way this must operate 86 to 87% of the market share, I have no doubt that this is a good investment. There is already the following generation. 86, you're looking at Blackwell, then you're looking at Rubin, and then you're looking at the very next ones, Jensen Huang says. On Wall Street, there's an old proverb that goes, trees don't grow to the sky. However, trees aren't stocks, are they? These are businesses, and they change throughout time. However, what about other aspects of the AI narrative? Do you have any concerns regarding circular finance and similar issues? The circular trade of the past is not at all like the circular trading that is currently being discussed. Real revenue, performance goals, and equity ownership are all present. In terms of AI, where do the trillions of dollars originate from? Indeed, the more efficient gas station, the more efficient revenue. And the increase of the margin will be the results of the ancillary spending. They say things like, okay, yeah, they're just cutting deals with everyone, much like OpenAI itself. I had a cousin who did that, but he was imprisoned, you know? I believe it was called clipping checks, when they cut trillions of dollars in deals. However, people ask, where do they get the cash from? Since this is for all the marbles, they must make the deals. They won't live if they don't. Charles, every company in the world will either adapt, adopt, or fail. Earnings, margins, revenue growth, units sold, improved treatments, and improved medications are hence the sources of funding. There are now 100 times as many use cases. The worst risk, in my opinion, is that because the hyperscale capital expenditure yields such a high return, they increase it even further. Therefore, the group of people who have been more dubious of AI productivity than younger growth investors is the one I'll describe as senior value investors. There are obviously outliers, but that's how I would group the people I speak with. The older value investors, I believe, would also argue it's clear that the return isn't that high. The capital expenditure is insane. In the end, that will be detrimental. If the capex increases, they can be correct for the wrong reasons. It is more likely, in my opinion, that the corporations will want to invest more capital expenditures and reduce the cash flows to zero, or negative if the return is fantastic for a while. You might become a bit freaked out about that, but in the end, I believe you'll return to the mindset that this stuff works, and it's good, and things can get better. What about speaking of low expectations? You claim that both Google and Amazon have too low capital expenditure expectations, which is remarkable given the magnitude of the figures we're already discussing. You see, Scott, you look at the street statistics for capital expenditures for those two. Google's capital expenditures are likely to climb by around 12% in the upcoming year. Even lower is Amazon, which is in the high single digits. It's nearly unreal, too. How could experts possibly have anticipated this? However, if you look more closely at Meta, I believe that's a stronger comparison, and that they'll be increasing by a significant double-digit, most likely between 30% and 40%. It may not happen this call, but I believe you'll see both Google and Amazon sort of just say that they're going to keep spending in this capital expenditure. However, I believe those figures must rise sharply as we move into Q for profits and next year's estimates, and it benefits businesses like TSM and Nvidia, which we also hold. Although I am aware that you don't, it appears to me based on your top holdings that you are highly exposed to some of these other AI power names. Would you stick with them?